Hi, folks. This is Sean Hyman from The Logical Investor, and I wanted to show you basically when fundamentals don't always show you the entire picture. You'll know that in my strategy, I have a fundamental, technical, and sentiment strategy that are really a triune type thing that's combined together, and there's a reason for that. It's because collectively they tell you a lot and show you a fuller picture than any one of them alone. And if I had to only have one that I could have, it would be fundamentals, because they keep you out of the ditch and keep you out of trouble more so than anything else. And they instill the most confidence in what you're investing in, because charting, you see squiggly lines going up and down, but with fundamentals, you can tell how big of a company they are, how much cash they have in reality, how much debt they have, etc. And that can instill confidence into how solid and how big of a company they are, or how flimsy of a company they are, and how apt they are to go under. So when you have a fundamentally strong company that the chart's going haywire out there, and there's a lot of volatility, you can have a lot of solace in the fact that there's solid fundamentals, and you can sleep easy at night in the midst of the daily volatility and gyrations that really don't add up to a whole heck of a lot. But then there's the flip side of the coin, where occasionally you'll get at times where the fundamentals look okay and seem to justify an investment, but then the technicals and sentiment say that it's really not the case. So Micron Technology, symbol MU, is one of those cases. So let me go to the fundamentals of this stock, and I'll show you, because a lot of people camp out on the fact that it's a huge company, $52 billion, that has a trailing PE of just shy of 4 and a forward PE of just over 4, and that's where they camp out. And no doubt, it's got decent fundamental. They made $19 billion last year, got $6 billion, almost $7 billion in cash, and debt's only $4 billion. So fundamentally, there would not necessarily be a reason not to get into the investment. And I've been warning about this one for a couple of months, because it's been, or really more than that, because it's been a hot stock, so to speak, as far as people trading it, and in the news headlines. And a lot of their justification has been it's a cheap tech stock, meaning cheaply fundamentally priced. But there's several things that I'd like to point out, and one is this stock had gotten far away from its 200-week moving average, which that alone, and historically far away. Like, this is further away here than even this was here, and then that was another example of a time when the stock was overvalued, and it was likely probably not fundamentally overvalued as well. There's another stock I'll show you here in a minute that fits the same bill. But so Micron, anytime it got unusually far away from its 200-week moving average, it posed significant risk, and eventually that risk shows itself and comes back to the 200-week moving average and then some. So here it runs up again from the 9s to 64s in a relatively short amount of time, year and a half, 2 years time. That's massive gain in such a short amount of time. So the angle of the trend is typically unsustainable. A more sustained move is something like this or like this, things like that. Those are more sustainable moves. But when you get moves that are like this or like this, they are ultimately unsustainable, and they will come crashing down back to their 200-week moving averages sometimes, and then some. And the further they stretch away, the more likely that they are to even go well below that 200-week moving average. But there was also other indications. The RSI was dipping down when this was looking like it was getting toppy and far away from its 200-week moving average. Its MACD was slumping over as well when this was starting to happen. So between the price being very far stretched away from its 200-week moving average, which that alone shows you the risk, and it shows you also that the sentiment is extremely bullish. and that investors and traders alike have gotten way over optimistic about the stock, and the likelihood of it coming down in the near to medium term is huge, and the risks for sure are huge. So there was technical warning signs all over the place, and that's why I say the fundamentals have to matter first. I really don't care how good the technicals are if the fundamentals are weak. If the fundamentals are weak, I ultimately cannot have confidence in that stock. And if it were to start to break down in the least, I wouldn't have confidence in holding on to that. So fundamentals give you the faith to ride through, dips onto the next highs. But when the fundamentals are strong and the technicals are just historically out of whack, meaning the price is way away from the 200-week moving average, technicals are slumping, warning of a decline as well, and then later on you have further confirmations like it breaking this steep uptrend line and breaking below its 50-week moving average. These are just huge technical signs and warnings, and so I had just been warning about this one, probably $10 ago in stock price with it, when it was still very elevated. So that's one of them. Another one, just to show you that this is not an isolated example. Another one that doesn't, that is, could be viewed as a tech stock, even though it's a very mature stock. That typically doesn't have a very high PE. You've got Apple, $1.1 trillion company. Trailing PE is 20, but forward PE is 16.59. Well, with the S&P 500 having a PE of like 25, 26, that's not necessarily, while it's not cheap, it's not expensive relative to the market, and they're, they have good fundamentals otherwise. 22% profit margin. They made over $78 billion last year in earnings. Over $70 billion in cash just on their U.S. books. They've got, I think, a couple $100 billion or so when you consider what they have overseas and here. So very cash rich, probably the most cash rich company that's publicly traded in America and probably the world. And then total debt, $114 billion, which sounds like a lot until you remember that it's $1 trillion company. So fundamentally, it wouldn't necessarily throw up red flags. It even's got a decent dividend. But when you look at it technically, and one of the reasons why I just can't be in it right now, Apple is one that we have invested in through the years on and off. If you were with me as a former subscriber in Ultimate Wealth Report, and we've had tremendous success with Apple through the years. Probably one of our biggest success stories. But when the price starts getting too far away from its 200-week moving averages, and when the price starts going parabolic, the risks are huge. So fundamentally, believe it or not, up here, Apple was not an expensive stock on a PE basis. Yet it still didn't stop it from going from 89 to 49. So I mean, that's almost cutting in half. I mean, it's huge. And yet, PE-wise and fundamental stability-wise, it wouldn't have thrown up the red flags. But sentiment-wise, we know it's out of hand because this price has, gone a mile away from its 200-week moving average, and we know technically this angle of trend and this far away from the 200-week moving average poses high risk. And then, of course, you start to have things like the RSI tip over, and you've got, the MACD start to tip over and all kinds of things that warn of this decline, and sure enough, 89 to 49 before it ends. Then, some time later, you have the next run up, and again, here it's still not expensive on a PE basis, but yet it doesn't stop it from going from 126s to 87s. Which is a pretty darn good percentage cut as well. And the price had gotten very far extended away from the 200-week moving average once again. And you had declining RSI, and you had declining MACD as well. So here we are again. Again, the PE I just showed you is not expensive again. Not dirt cheap, but definitely not overvalued or overly expensive. It's a little bit overvalued for Apple's PE, actually, because historically Apple doesn't get tremendously high PE. But nonetheless, compared to the market, it's not expensive. But yet you've got this move that has been too steep angled right through here, but then even picked up too much steam right in here, as do sometimes the final blow-offs that, like you see here and like you see here, is happening here. So this is very dangerous and high risk. The RSI is slumping over, so as the price has gone higher, the momentum was actually slowed down. And while the MACD went higher, its MACD histogram is already starting to slump over, which tells you that that a sell signal is likely coming very soon. And so you've got the RSI already slumping over, MACD very extended and losing momentum on the histogram, and the price very far away from its 200-week moving average like it has been in the past. And guess what's going to happen? In the past, this has gone from here to its 200-week moving average and stopped. But this is so far along in the tooth, this rally is, that this one not only likely goes from 229 back to its 200-week moving average at 133, but it actually will likely far surpass it and have a very very long downtrend. So, but even if it went just from 229 back to 133, that's a heck of a cut, right? So, and again, anytime the price is way away from the 200-week moving average, you can always tell the sentiment is way over the top, overly positive. Sometimes we can pick up sentiment in volume and the bullishness or bearishness, but another neat way to check it out is to see how far the price is away from the 200-week moving average. Anytime it is there, it doesn't mean it has to come back down tomorrow. After all, this one spent a little while up at these levels, many months, and then most of it came crashing down seemingly overnight from the 120s to 87. Then it bounced back up, and then it found itself back there once again. So it spent the rest of the year overall declining. So these things can get you can avoid a lot of downside by really using the full package of what I've put together with fundamental analysis, technical analysis, and sentiment all together, and put them together. I believe they produce a clearer, truer pie, the full picture than does any one of these components alone. And they all have their benefits and advantages. And where one is weak, the other one is stronger. So fundamentals always have to matter first, because that's what you're really buying. You're really buying a real company with real earnings, makes real products, or delivers real services. But after that, the charts also have to make sense. And if they don't, many times the fundamentals will reflect the chart and vice versa. But when they don't, and the fundamentals are fine, but the technicals are way out of whack, I pass on that investment, whereas a lot of others would just pile into it because they go, well, it's fundamentally solid and cheap, so therefore let's buy it. And they can literally lose, 30%, 50%, etc., of their money in a relatively short amount of time, like a year or less. I mean, because from here to here, you're at about a year or less. From here to here, you're under a year. And from here to here, you'll likely be a year or less as well. So imagine, being able to avoid a 30 to 50% retracement in price in a year or under. That's golden. And that's something that the technicals, which show us both technicals and sentiment, can tell us that literally the fundamentals don't tip us off to. And again, most of the time, the fundamentals are our biggest beneficiary. But there are times, and that's why I like to use all three, because we invest in the logical investor portfolio in stocks that meet all three of those criteria, that look compelling from all of those. Fundamentals first, technicals and sentiment second. But if the technicals and sentiment have massive warnings, we avoid it altogether, even if it's got good fundamentals, because what's going to happen is the price is highly probable to have that 30 to 50% correction. And again, with different stocks, it'll be different percentages. But the point being is it'll come back down to that 200-week moving average at a minimum, and sometimes very much lower than that. And you'll still have the same fundamentally solid stock at an even cheaper PE And so there you'll have your cake and eat it too, whereas you'll have cheap fundamentals, the technicals, the fluff will be out of them, and they'll be reasonable and somewhat lower risk then. And the sentiment will have turned from uber positive, so to speak, to something more realistic or even bearish. And when that attitude flips, and has been for a while, that's when the opportunities present themselves. Each time we were in Apple could do no wrong, and it was the best thing since sliced bread here and here. And every time when we got into it, which was around here and here, it could do nothing right. It was being touted as a has-been company, etc. So the news and the sentiment will always be atrocious when you should be buying, and it will almost always be super positive when you should be selling, or if you're not in it, avoiding the risk of buying and being in that stock. So that's why you'll never be able to use the news as an indicator. The news is a horrible indicator. It just tells what is and what has been, and investing has nothing to do with that. Investing has everything to do with where will the stock go in the future, and the newscasters can't tell you that. Okay, thank you so much for watching. Again, if you're seeing this and it's not on our site, because people share this on their Facebook, Twitter, share it through email, various other places, you can look us up at SeanHyman.com. That's SeanHyman, SeanHyman.com. Thank you so much, and God bless. Bye-bye.